Oh, but I
You don't need the rest of the pictures.
but I did not upload the picture.
Well, yeah.
Sort of like because privacy thing.
No, I understand. But what I'm saying is, okay, I would like to take a look at the pitch, right? And it's going to be a very useful process. So it's, I don't need to see the others. But what I need is my segment. So I think we should do that. Please figure out the flow.
If everybody wants to do that,
is everybody okay with that?
I mean, what we can do is we can record the pictures, but we don't have to upload, and then we can just share your pitch on these people.
That's good, right?
But this is only including premium version. So yeah, if you're interested in that, we can do it. Just tonight, just upgrade the membership to premium. Okay. But can't find what. The video? Did you go to Explorer webpage?
Yes, Explorer.
No, Explorer.com.
Explorer.
But we can put a link in there in the Facebook pages. Right, so I'm trying to drive up my YouTube statistics.
But in Explorer.com, where are you going to find it?
So just go to the bottom of the page and then click on those videos. But the other thing, you can just go to YouTube and click. Okay, I'll be right back.
Nghe báo thấy cả nên làm những marketing.
Một tay ăn gói, một tay còn xuống bắn. Vừa ăn thì sự gây nghĩ tính mình làm gì đấy từ mình đăng ký với em đã sẽ được lại không muốn làm nhanh hơn thì qua phương tiện suy nghĩ 2 triệu bất kỳ con người thì là nó bây giờ làm cái gì đấy một cái recommend nó được theo tuần này văn phòng sư trái là đến ví dụ như là đi hai chỗ này được.
Okay. Okay, everybody ready? Can Zoom participant, can you hear me? What's it? Zoom participant, can you hear me?
Yeah, I do.
Okay. Don't forget to send your attendance information to Lainey so she knows that you were here.
Yeah, sure. Thank you.
Yes, which company are you from? Hello? Wait, which company are you from?
I didn't hear clearly.
Say again.
You repeat something.
Oh,
She asked you to repeat the question.
oh, which your company?
Talk about your customer care.
What?
Say that again.
Oh, typing? Oh, great. Thank you. Yeah, welcome back.
Yeah.
Okay.
Okay, so welcome back, everybody. If you remember, we finished yesterday on this slide talking about the roles played by entrepreneurs and venture investors in the venture funding process. I'm going to continue today to talk about the venture funding process, and then we're going to talk about the financial forecasting and how to use our spreadsheet model to do a financial forecast for your startup. I'm going to look now at what I call the VC method of finance. So the VC method of finance is different from the VC method of valuation that we're going to learn about when we get to valuation. The VC method of finance is, I think, one of the most exciting and important innovations in finance in the last 50 or 60 years, because it is the VC method of finance that enables high growth, high tech companies to raise the money that they need to go from early stage, seed stage startup to a successful, significant size company. In the absence of the VC method of finance, this would be extremely difficult or almost impossible. And if you take a look at the number of successfully funded high growth startup companies before venture capital method of finance was introduced and after, you're going to see a huge difference in the number of successful companies. So I want to look at that first, and then we'll look at the various stages in the VC method. So the VC method of finance is, the innovation in the VC method of finance is to break down equity investments into multiple stages, the multiple sequential stages, whereby the company is able to raise more and more money at higher and higher valuations as the company accomplishes some set of milestones that it used to raise the previous round of funding. Now, let's think about why this is so important for funding successful high-growth startups. From the current stage to the exit stage. So let's say to take your company from where you are today to, for example, $100 million exit. How much funding do you think you're going to need to raise over the lifetime of that lifetime of the company from now to exit?
Then
10 million, maybe more, right? Maybe somewhere 10, probably to get to 100 million, you're going to have to raise somewhere between 10 and $20 million of funding. Now, this can vary, maybe a little less, maybe a little more. I mean, does anybody think they're going to be able to do with a radically different amount? Much more or much less?
we always hope to get basically profits to finance growth. But it's a good idea.
Yesterday, I was certain Singapore, the race absolutely.
Not true. I know those opening founders.
Oh, what's the truth?
No, they never said that they did raise money. It's well established. They raised one round of funding. So you're right. You're right. They raised a lot less. They raised one round of funding, which I believe was something like $500,000 Singapore dollars. But okay, so that's a good example. But they did sell at 38 million. So they did sell at not 100 million, but still exceptionally great performance for a very small amount of money. And a lot of the acquisition value that they received was in shares of the company that acquired them, and that company was pre-IPO at that stage. So the pre-IPO shares that they received in that company, I believe, have significantly increased in value. So the total value of that deal now may be a lot more than the original, like, I think 38 million US that they got. So yeah, that's a good example. And there's the company that usually people talk about is 37 Signals. This is a company that has done quite well at raising funding. But although we can come up with a handful of exceptions, the reality is that these are the extreme outlying cases, and the vast majority of companies that get $200 million valuations raise $10 to $20 million in venture funding. So that's why we see many more companies created in this space with the advent of this VC method of funding. You know, why is that? Well, it's worth not just taking that as given by looking at that in a little more detail. So let's say the way that we're planning our fundraising, we're going to go out and raise our first round of funding. How much? We didn't talk about this yet, but we're going to talk about it today. But I'll tell you, you know, typical first round of funding, we're going to raise a few, let's say, I would say on average, $200,000 to $500,000. This is a not unusual first round of funding for most of the seed stage companies that raise money. Now, how large do you think is the universe of investors who are willing to invest $200,000 to $500,000 in a seed stage startup? So just the whole universe of investors that are willing to do that. And we don't worry about the number now. Is it very small? Is it reasonable size? I would say it's reasonable size. What is the universe of investors that would be willing to invest $10 to $20 million in that same exact startup right now?
Non-existent.
It's vanishingly small. So this is reason one why the multi-stage equity finance in the VC method is so crucial, because we're looking at the exact same business, the exact same company with the exact same plan. We know that this company may need to raise $10 to $20 million to get from that exit. If the company had to raise all that money at once up front, they would never get started. Because almost no one is willing to put $10 to $20 million into an unproven startup like the ones that we work with in acceleration programs. So that's issue one. From the company perspective, it will be very difficult to find that money. However, the situation is even worse than this. Why? Let's say, imagine the universe of potential investors who are willing to do this. It's vanishingly small, but it's still non-zero. So let's say there is an investor out there that is willing to put $20 million into your startup right now. You find them. Okay? Just imagine that. I guarantee you, you will not take that deal. You would never take that deal. So why this is so important? From the entrepreneur side, I'm arguing that it's almost close to impossible to find an investor that would want to put, for example, $20 million into your company today. But I'm also arguing that even if you could find that investor, you would never, ever take that deal.
Well, it's probably going to take about 90% for everything.
Not just that they would want to take, but what deal could you ever do with that investor that would be fair to both sides?
It's really impossible.
It's impossible, because for a $20 million investment right now, that investor would have to own effectively all of your company. There's no way that you could ever agree on any reasonable valuation for your company that would leave you with any meaningful stake. So you would never do the deal, even if you could find the investor. So the multi-stage equity financing VC method solves both those problems. It solves the problem of not enough investors willing to put money into companies that don't have the metrics to support investments that large, and the fact that entrepreneurs will be unmotivated to accept investments from investors who will be willing to invest in them. So this is what is so exciting about this method, because actually it works best for both sides. Now investors get to invest a reasonable amount of money at reasonable valuations. Startups get to raise all the money that they need over the lifetime of the company without giving up horrific amounts of equity. Understand? So that's where we're going to go now, look at this process in more detail. So the fundraising process for venture capital funding begins here with founders capital. So we start founders capital with what we call OM. OM means what? It doesn't mean own money. It means own money. Because why? There are two types of money in the world. OM, and what's the other type?
Other people.
OPM. OPM. Other people's money. So all the money in the world can be categorized as own money or other people's money. And the reason that investors want to see that entrepreneurs have begun their funding journey with own money is that we tend to have very different attitudes toward these different types of money. And specifically, we tend to be much more willing to spend other people's money than our own money. Agreed? So, and just to help illustrate that point, I like to do a little experiment. So,
Another good example.
okay, let's see. We'll try. So, I want everybody to raise their hand if they have ever flown on airline. Ever taken a, raise your hand and keep it up if you have ever flown in a commercial airline. And then keep your hand up if you have ever flown in economy class. Keep your hand up if you ever flew business class. Keep your hand up if you paid for your business class ticket with your own. So, then you.
Well, that was
company with you. Company. So
the company paid. I didn't pay.
yeah. So it's very common. Like I ask this question all the time, and we see everybody flies economy class. Some people fly business class. And I don't even have to get the first class, but the vast majority of people that fly business class on other people's money. When somebody else is buying the tickets.
Because, you know, all the companies that flew either business class or first class rate, the only reason that they put me in business class and first class because it was the last minute and there was no other option. Right? It's not that they were so generous and, you know.
It's not that. I'm not talking about other examples, but okay, let me put it this way. When
Because I didn't even know I'm going to be in business class until I actually got to the airport and told me, okay, you know.
So, let's say in any of those situations, did you ever go back to the company and say, please downgrade me to coach so we can save money for the company?
I did.
Yeah. So,
But that was a startup.
No, but
It was in a startup.
let's say in a big company, did you ever do that? Does it?
As I said, the only time I knew about it when I was already in the airport. It's too late to do anything about it.
Anyway, but I know a lot of people that have been in this situation. I've been in this situation myself, and I've asked this question to people, and nobody ever thinks about it. Nobody who's working for a big company and gets put in business class complains and says, I want to fly coach so I can save money for the shareholders. Unless you own the company, which means it's not a situation, then it's your money, not other people's money. So why is it that we make this distinction? It's human nature. Doesn't mean people are greedy. It means people that if they feel they're entitled to spend somebody else's money, they do. If it's their own money, they squeeze it till it bleeds. So that's the basic human nature. And we, as investors, we don't want the entrepreneurs thinking about the investment in the company like that. So we don't want to put money in the company and suddenly the entrepreneur who was flying economy class is suddenly flying business class. So we want the entrepreneur to have put their own money into the company so that when they get investment, they feel like this money is our money. It's a mixture of your and my money. It's not just other people's money. Actually, for me, I fly every week. And you know what class I fly? I fly budget airline every flight. I don't even fly economy. I don't even fly regular economy flights.
But, obviously, Singapore and Hong Kong, there's so many options. And, it doesn't really make a lot of sense to do anything else. Right? It just doesn't.
I mean, it's a 2.5 hour flight. I feel like
it's a plus.
It's oh, I only fly Singapore Airline if I'm flying to the US. But if I'm flying to local, I fly Air Asia or Tiger, or sometimes Vietnam Airline, because sometimes Vietnam Airline is cheaper than Air Asia. So, that's it. Anyway, so, but we want to see that an entrepreneur has some of their own money at risk so that we feel like they're going to treat the spending like so then this raises the interesting next point of how much own money should an entrepreneur have in the business? You said?
So 20 or 30
You said it depends.
So many times. It's only money that you could spare. So, yes, money that's actually spare. That's what you're supposed to think. You don't want to spend what you don't have, or spare to the point that you can actually lose everything. Right? You don't want to spend too little that you cannot really get to. Well, I can tell you what we did with our own company. We just thought about, okay, how much money do we need to get in order to get to there so we can try and demonstrate to investors that we have a solid case, including giving case studies and all that. Right? And also looking at how much money the company needs in order to get there. So what is our money? What is that? Of course, I'm much older, so I can spend much more of it, kind of my case. Talking my wife basically.
TMI.
I think that's actually very relevant.
No, I agree. Actually, I agree 100% with exactly what you said. I think that, and it's a great example, I think that the correct answer is it depends. And it depends on what circumstance, the circumstances of the entrepreneur. So I like to put it this way. The right amount of money that you need to put in is the amount that constitutes for you what we call skin in the game. Skin in the game. Who's heard this expression? And what is it?
Putting money in.
Oh, okay. Where does it come from? Skin in the game.
Probably.
Like which domain? It comes from what domain? So it comes from sports. It's skin in the game. Skin in the game means the player is so dedicated that they are willing to injure themselves to, for example, stop the other side from scoring or to make an important point. Now, what type of injury? They have some skin-related injury, like they dive on the playing surface. Instead of just running, they dive and they tear the skin off their arm, and they leave the skin in. So their skin is left in the game. And this demonstrates commitment. And I think that the reason I expand on that is the imagery is really important. Why? We don't expect them to leave their liver in the game, or the lungs in the game, or even or their heart in the game. Meaning, the amount of money, like you said, that you put in should be money that you can afford to lose. It should be painful, but not debilitating or crippling or fatal. Yeah. So I think, and this will vary from person to person, right? If somebody is older and single, or somebody is older and has 3 kids in private school and a mortgage and a car payment, or if somebody is a recent grad living at home with their parents. So the definition of skin in the game will vary a lot based on you. So you have to think about, what is that number for me? And that would be an appropriate amount to invest. Now, although I say that, I do agree that we shouldn't put kidneys or lungs in the game, but actually not every investor agrees. So some investors will want entrepreneurs to make what some investors will want entrepreneurs to make what I consider unrealistic contributions of their own. Example, some investors want entrepreneurs to personally guarantee, for example, a loan in their company. In fact, I had met with some banks in Singapore who were developing their venture debt programs a few years ago, and at least one of the banks was requiring that personal guarantee of the loan to the startup by the founder. And to me, this is like the lungs in the game, because the amount of that loan, the amount of most of these loans is way more than the typical entrepreneur that we work with is capable of losing without destroying their entire financial, personal financial structure. So I remember when I was talking to the person from the bank that was developing this program, and I said, I think it's makes the instrument totally useless to have the founders give a personal guarantee. And the person said, I don't know, we talked to some other people who said this will encourage personal responsibility if they have to personally guarantee the loan. So I said, oh, okay, if that's true, why don't we have the bank officer that approves this loan also personally guarantee? Because that will encourage responsibility on their part. And you know what their reaction was? How do you think they responded to that? They laughed. Like we would never do that. So I thought, yeah, so how can you expect an entrepreneur? So I think there's such a thing as too much skin in the game, and we should avoid that. But no skin in the game, also, it's going to be an issue for investors. For investors who don't want to know about that. I have had, I remember I was talking to one entrepreneur, said, how much of your own money have you invested in this business? And he said, I can't invest my own money in this business. It's way too risky.
That's a good start.
Yeah. But and I said, oh, I see, but you would like me to invest my money, right? Yeah, like that. So I think that creates some cognitive dissonance. That's not good for the rest of the members. Okay, so we have some own money at risk. But if we want to put some numbers around that, I would say we very rarely see entrepreneurs that have put more than like $100,000 into their business before they reach us. And most is a lot less. So usually in the tens of thousands range. I think the most I saw in the last couple of years was somebody had invested $500,000 ago. But that's already a lot. So, okay. Then next stop after own money is FF&F, which is friends, family, and fools. So friends, family, and fools. And we typically will consider this as a part of founders' capital. And so what's the significance of friends, family, and pools funding? First of all, why do we say pools at the end? Because we believe that friends and family have non-financial motivations for investing in startups. Friends and family invest in startups because they love the entrepreneur. They know and love. But we think if you're not friends and family and you're investing in a startup for non-financial motives, or you believe you're making financial investment, then probably relative. Okay. So what's the benefit of the friends and family fund?
There's benefits. Many times it's the non-interest money, for example.
So we can say it's cheap.
It's actually a lot of times it comes along. So it's cheap, if we take that perspective. And they could be here in Vietnam. Actually, I've heard many cases that actually it's a very expensive exercise because people sometimes don't have the discipline. So they give you money, and they're okay if they're getting something out of it, for example. Or if they think you may lose the money, then they're going to start chasing you and finding your relationship. So there's no understanding the discipline. Okay, you put money in, for how long you actually put it for, and then you can actually put it back. So it can be, yeah, happens a lot, right? It can be dangerous.
So that's a negative.
It's a very negative.
So what are the other positives? Let's look at that. We can definitely there are negatives too. So what are the positives first? One is it might be cheap and easy, but what are the other positives? Well, let's say you have a positive in your fundraising process with an investor who's not friends and family.
Oh, it's very significant. And so,
But what else? There's some important, I think, signaling benefits of friends and family.
some ability.
Emotion driven decision making.
No, positive. That can be one, but how about positive? Like, what positive conclusion can I draw from this as an investor?
You have the ability to convince
And convince who?
other people, basically.
But okay, that's a good point. But this can be through any funding. But that's okay, because I think there is some special benefit of friends and family funding. Presumably, your friends and family are the people that know you the best. Agreed? That's why they're friends and family. And so we learn from the fact that you have friends and family funding signals that the people that know you the best are willing to invest in you. And that's a good sign, right? That people that know you, and I guess your family has known you maybe for your whole life, and friends may have known you for a long time, and they're willing to invest in you. And we also see another positive benefit. Another benefit is you're willing to bring them in on this investment, which also, unless you are lacking, all moral compass, suggests that you really believe this is a good investment, because we think most people don't want to swindle or lose money for their friends and family. Yeah, so those are the pluses. Minuses. Look at minuses. So there can be, oftentimes there are documentation problems, like lack of documentation, which can become a big issue later when you start to look at due diligence. There can be unclear understanding what's actually being paid for. So what does this money that I put in the company, I get what, when? So yeah, I would say, my advice would be if you get friends and family funding, you should treat it very seriously with real documentation. So with real agreements, not just like, here's the money and handshake. Because although that might seem easy at the beginning, it's not going to be easy later when there's misunderstanding. And especially since you're dealing with friends and family, you don't want misunderstanding about investment in your business to lead to like a breakdown in that relationship. So, okay, and then let's look at what are the negatives of no friends and family funding. That's one, and then what else? Okay, but that's true. But the other big negative is the opposite of the signaling benefits I mentioned before, right? So let's say no friends and family funding. This means, I mean, what we hear when we see that is, actually, you don't know one person, you can't find one person in the whole world that you know that's going to invest in your business. Why? I mean, why is it? How come nobody that knows you wants to invest in this business? Or,
I'm not sure I completely.
but it's true. Well, two reasons, right? Either one, nobody wants to invest, or two, you're not willing to show them this investment because you're not confident.
No, I don't think it's an issue of confidence.
But this is $100 million company, but you don't want to cut in your friends and family.
No, I do want. Okay, but
Don't you want to share with them? Don't you want them to get rich too?
yes, I do. Okay, but I would not go to them. I would like them to come to me.
That's, and I get what you're saying. Like, there can be other reasons too.
Yeah.
And it could be like, okay, it can be something like this. It can be also, we do have friends and family that trust us, but none of them are risk takers, or they're very conservative, and you don't want to push a risk of investment on them because you know they're comfortable. So there can be a lot of other risks, but it is. So I don't think that any investor is going to say, oh, no friends and family money, forget it. But definitely, if you have friends and family money, it's own money and friends and family money is good stuff. So, okay.
So I invest $1,000 in your company, if you invest $1,000, you become an investor, which
Okay, we'll check that. Sure, can do a lot of it.
Is it angels, considers as schools?
Oh, so, okay, so we have angels in the next category. So usually we consider angels as the next stage of fundraising. And here I have said, I have listed angels and seed investors separately. I'm making a distinction there as I consider an angel is an individual investing their own money, and a seed investor is a fund manager or somebody investing other people's money. This can include, seed funders can include not just specialized venture capital funds, but incubators, accelerators, companies, government. We talked about these yesterday, different sources of funds. This is where you will encounter that for the first time. So, seed or angel round funding.
Angels.
Oh, yeah, I mean, actually, we have invested alongside friend and family before, you know, at that stage. So I don't really buy that it's necessarily foolish, but it's just an industry phrase I want everybody to know. So, okay, we get with our own small funding, we set up the company and start doing some early product development. Then we go out to the market to get seed or angel funding, which is where we are now, right? We're all in, I mean, most of us, or as far as I can tell, all of us are in this chevron. So we're finishing here and we're going to here, and we're in an accelerator program to help facilitate that. So this round of funding will be used to do what? In the general terms. Oh, I mean, the money that we raise in the seed or angel round will usually be used to do what?
That's what the next stage. So say,
To get us to the next stage by, actually, each stage of funding is used for what? Yeah, okay, it's growing revenue, driving revenue, growing the company, and we can sort of lump those together under the heading of increased value. So lead stage of investment is used to drive value creation so that we can increase the value of the company so that we can raise the next round of funding at a higher valuation. And this is why this multi-round equity financing works, where single round financing doesn't work. Because what happens? Let's say, we can think about it this way. Let's say you put your $15,000 into the company. You're also trying to increase value. You're trying to go from 0 to whatever your seed stage valuation is going to be. And what happens if you just can't do that? Actually, you can abandon this and do something else. So you also saved yourself a lot of money, right? You invest a small amount of money, you try it, maybe it works, maybe it doesn't. If it works, then you go raise the next round of funding. And then the same thing happens in the seed round. So you get your seed round of funding. The seed round funding is invested to grow the company to the next stage. If it works, great. Then you raise the next stage. If it doesn't work, the money's gone and you do something else. So, of course, there's other variations, pivot, blah, 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 blah. But let's say ultimately it works like that. Now, so typical amounts, so seed or angel funding, some types of angel funding can start, like $10,000, like what we do in accelerators investment. It can go up, I would say seed stage funding can go up to around $500,000. Seed and angel funding can go up to around $500,000 in Southeast Asia. Sometimes you'll see angel or seed rounds between $500,000 and $1 million, but most of the rounds that I see are between $200,000 and $500,000. And this means valuations will be somewhere between $1 and $3 million. So here we see downsize, I would say 200 to 500, valuation 1 to 3 million. Now, what do you use that money to do? Use that money to drive growth. And then if you successfully drive growth, then you go to raise the next round of funding. Now sometimes there's an intermediate round in between these two that we call the venture round, but let's skip that and say we go straight to Series A. So Series A is traditionally the first venture capital round. Now in the seed stage, you might get venture funding from, for example, a fund like Expara, which specializes in seed stage venture capital. But most of the venture capital industry is clustered around these stages, A, B, and C, and maybe B or E or F. But this would be our traditional first venture funding round, Series A. So Series A would be in Southeast Asia somewhere 1 to 5 million, at valuation somewhere 5 to 15 million.
How would you define what's called pre-series A?
Yeah, so there's like pre-series A is probably what I was calling venture round. So pre-series A or venture round, somewhere between $500,000. But one thing
it's kind of like, from your perspective, similar to seed.
big seed or a venture. So for me, another thing to note here, a lot of these terms don't have clear, precise definitions, and people use them to mean different things. Like, for example, one thing you'll notice as you start working more and more in this business, you'll meet investors, venture capital investors that say they're early stage. But what does it mean? Like, some venture capital investors consider early stage means the company has less than $1 million in revenue. That's what they mean by early stage. For us, early stage means the company has nothing, or almost nothing.
Depends on the industry.
So it depends on you have to be careful about that, and you have to check how it is. So my terms are fairly common, but there can still be variations. So let's say our first venture capital round, Series A, and we raise 1 to 5 million at a $5 to $15 million valuation. And then if we're successful investing that money in growing the company, then we can go out and raise Series B. So Series B, typical Southeast Asia, 5 to 10 million of investment, and valuation going up to 20, 30, 40 million, or maybe more. And then Series C is going to be bigger, so that can start to be 10 million or even $20 million. And then if you need a Series D, you need even more. So not every company will raise every round. Some companies will raise additional rounds. So you might raise like a Series C1 or A1. Why would you do that? Because you did not actually reach what you would consider your Series B milestones with Series A. So you're not ready to go out and raise Series B yet because you don't have a new fundraising story for Series B. So you might do a continuation of Series A.
Or the VC tells you, okay, yes, that's what you want, but you're going to stage this.
But meaning,
Right. That's how we give you this milestone, which is milestone and the divisions about should we continue the series
Inspiration. Raising around 8 to 3.
so usually if you're raising another round with the same letter as previous round, it means you did not achieve the milestones you set out in the first round, which is not great. So, or it might mean, you're close to raising the next milestone, close to the next milestone, but you can't justify a valuation if you want to get to the next round, so you extend the previous round. The most important factor here, and again, there's a lot of ambiguity and fuzziness around the letters and sizes, but the key points are each round that you raise, you should be raising more money and usually significantly more money at higher valuations. If this is not happening, then something has gone very wrong. So for example, let's say, and this is also something you have to think about when you're getting valuations for each round. So sometimes you might think, I should get the highest possible valuation in each round, which is generally correct. But you can be in some situations where you get too high a valuation in one round, and this has an impact on your next round's ability to raise funds. So I see this in some local deals where companies that it seems clear do not warrant the valuation that they're getting in Series B are definitely going to fail in Series C. Because if your valuation in the Series B is way too high, then by the time you go to raise Series C, the market realizes it was way too high, and then you have to raise Series C at a lower valuation than Series B. This is going to have a huge impact on your Series B investors, and it also sends really bad signals to the market. Because the market expects that valuation is going to be going up the whole time. As soon as valuation goes down, we call that a down round. And down round is not good. Not good for existing investors and not good for your investors.
The A2 is round.
What's that?
A2 is be round.
So let's see if we just keep our fundraising smoothly increasing amounts, increasing valuations. How do we do that? It's very simple. Just meet the milestones in every round. Yeah, if you meet the milestones, and you don't screw up, and
Is that the reason why there are a lot of deals get undisclosed valuation?
why don't they disclose?
Could be.
Because at the end of the day, if you're going to get into discussion next round, you're going to be exposed to all this information.
The investors will know. It just means it's not publicly announced.
Not limited.
I mean, only
But you're going to invest in a company if you're only going to get to
No, he needs to publicly announce. How come they don't disclose publicly? Well, so I think usually when the deal parameters are not published, it's because usually somebody in the deal is not that happy with some numbers. Because when companies raise a lot of money at exciting valuations, they like to announce. So usually if I see the undisclosed parameter, I usually think probably they weren't that happy with the numbers.
I thought about the numbers. People may understand that they actually have more money than you actually claim you're going to have. So,
Yeah,
some people don't want to know. They don't want to be.
Well, I think investment is not So it's
No,
not,
no, no,
it's
no,
not,
no, it's not about that. If you invested $1 million, how come you have that's
from an investor side.
So, and I think a lot of time, especially when you talk about private equity, that people don't want to be uniques.
Yeah, some investors are very shy.
Shy.
Yeah. Some investors don't want marketing to speak. Okay, so we got the venture funding rounds. Now you notice one thing is our hurdle rates, meaning the cost of capital goes down.
What's right?
The cost of capital goes down. Hurdle rates.
Yeah.
Cost of capital goes down. So why is that?
Less risk.
Why less risk?
More mature business.
So what is more mature, and what risks have we reduced?
Most likely, a lot of risk. You expect the company, for example, Series A, B, C, company already profitable, for example. So, and
Maybe.
yeah, of course, yeah. But, essentially, in much later stage, right, the company valuation go up, basically, you expect the company to be much more solid position, much less risk. All of this account for the fact that it should be easier for you to access.
So yeah, that's a good point. And I would say the clear risk that has been eliminated by each funding round is the risk that the company will not raise much money, which is always a huge risk for us. So once the company enters Series A, that the risk that they will fail before Series A is done. So it's sort of like life expectancy. Like, does your life expectancy go up, down, or stay the same as you get older?
Yes.
Up, down, or stay the same?
Well, it depends.
Average life expectancy goes up,
Yeah,
down, or
there's
stays the
this
same?
new go.
It goes up. It has to go up. No, it has to go up. I'll tell you what, it must go up. Let's say, what's the average life expectancy at birth for somebody in, let's say, I don't know, Vietnam, let's say Singapore?
It's important, I think, the first few years,
So let's say
there's more risk, but after that, actually, it's supposed to be really.
So,
But then you know the damage risk. Every year,
So let's say life expectancy at birth is 74 years old, for example, in some country. That means when I reach 75, is my life expectancy minus 1? No, now my life expectancy is 80, because the older you get, the greater your life expectancy becomes. But it has to be like that. Because what happens is average life expectancy is calculated based on all the people that have died already. So, or that will die ahead of you. So, as you get older, so meaning what? Like, let's say, for example, what's the probability that is the probability that you're going to reach 74 from your current age greater or less than at birth? It's greater, right? Because you have already made it to this age. So it's similar risk reduction. We know that the company that made it to Series A, they're not going to die in C. Companies that made it to Series B, they're not going to die in Series A.
Tell it to the insurance company.
Insurance companies have that exactly the same. But I get you. Because insurance company, they're more concerned with how much life insurance or medical. Yeah, because they're more concerned with the medical cost you're going to incur, which I'm not arguing goes down as you go. But definitely your average life expectancy goes up. So this is a very positive thought. Since you realize your life expectancy is higher now than it was at birth. Okay, so weakness.
Thank God I was not run over the last night. That's what you have to say every day.
That's also positive. So, and then we have some other subsequent funding rounds that we might go through, and then exit. So, I'll talk about exit in a little while more detail. But yeah.
About the hurdle races, it means that some later stage VCs will regularly not perform as good as the early stage VCs.
Okay. So, oh yeah, it definitely means that later returns to later stage venture capital funds will be less than early stage. So the average return will be in. Now, that also means a risk estimate.
Returns.
Risk and return. So, like early stage VC, they might have a 30 to 40+% return, whereas a late stage VC, maybe 15 to 25.
It's not business.
Across. Okay, so how much funding should you raise? Actually, the numbers on this slide are a little out of date. So I've revised these down. And now I think we should generally be raising at the first stage something like 200 to 500,000. And now, well, let's think about this in a little more detail too. Actually, how much money should you raise in each funding round? How much money should you raise at each funding round?
Getting to the next bigger milestone.
So enough to we talk about this already? So enough to get to one of 2 points. One point is what next funding round. The other point is at the end. Or what about before?
For example, you think, okay, if I need the money for the start, to have a strategy, which is just a global strategy, to say that's a milestone. That's what I achieve.
But let's say practical terms. Practical terms, we have to raise enough money to get us to one of 2 endpoints for each round. Not to that. How are we not going to that?
Seriously.
We either need to get to the next round before we run out of money, or cash flow positive. So we have to raise. Yeah. So we have to raise enough. But at least we remember. So we have to get either to cash flow positive or next funding. If we don't, we're going to die. Now, if we think about it though, when are we going to get the next round? When are we going to get cash flow positive? How long is it going to take? We don't exactly know because it's a prediction. So we should be more conservative, meaning we should raise a little more than that. A little more than we need to get to the next funding round or to get the cash flow positive.
How much is the
Yes.
I use 33%. For example. And that's
Just like number 3.
so that's the number I said I'm going to run because I need based on my
Maybe
forecast,
by 33.
right? 33%.
It's just the money you need.
I mean,
So
it's,
yeah, well,
but okay, I wouldn't say there's one rate number for that. And I think it will depend on how much you're raising. Like let's say if you're raising 200,000, then raising something like 275,000, maybe okay. But if you're raising 10 million, then raising 13 million might be a stretch. So I think it depends on your specific financial situation and how confident you are in the timeline. What's the company cash position like? And you also have to balance this with the more money we raise, the more equity we give up. So if we're raising 33% more, we're giving up 33% more equity. This can be significant. So let's say that means instead of giving up 25%, we give up 33%, which hurts. And so, but on the other hand, it doesn't hurt as much as we run out of money and die. So it's a very, very delicate balancing act. I mean, I would say, I would look at one way that I would think about it is we can think about how long is it going to take us to make it to the next round, which I usually estimate somewhere between something like 6 to 12 months to get the next funding round. So then let's say a nice margin would be to have something like 3 to 6 months of operating cash as a buffer in case we can't raise in 6 months. So how much funding is required? Enough to get us to the next round or cash flow positive. how much equity should we give up? So this is something we're gonna look at in increasing more detail as we get to stock valuation. But yeah, what's the right answer to how much equity should we give up? Is it as little as possible, as much as possible, or just enough?
As little as possible.
So, okay, so you might think, I heard a couple of people say as little as possible. You might think that that's the case. I would say probably not. I would argue probably not. Why? Okay, let's say you need an investor who wants to put in, you're raising $500,000 at the seed stage, and they want to do the deal. They're willing to do the deal for 1%.
Increase the valuation.
The last part of the less functional.
But let's say they offer that.
Correlation is too high that the next investors will not.
Okay, so let's try to get away from that. Let's say they're willing to do for 5% or something, where valuation is not going to be definitely a huge problem. But you want to do that deal?
Except I would best meeting. If somebody's going to take a look at whether to invest in you or not, and they will figure out that there was an investor that invested in me, that guy doesn't even know what he's doing, they're going to doubt the position.
Yeah, I mean, I don't really like the deal for a couple of reasons. One is,
Is it smart investor? Do you get smart money? You know?
yeah, I feel like, okay, it's not a normal deal, and when the deal is not normal, then I wonder why. Why is it not normal? So any deal that somebody's willing to do that's way out of the ordinary, then I'm suspicious. What are they willing to do for so long? Are they just really stupid? Are they just drug money? Like
Laundering.
yeah, like laundering money or what? Because there's some reason why they're doing it. And so that's why I say as little as possible may not always be the right answer. I would say fair answer is as little as possible within the reasonable range. So let's say we set a reasonable range of equity to go to investors, to share with investors. We would always target the bottom of that range. And the investors should target the top of that range, and then we should agree on something within that range. Because you can make the argument from the other side. From an investor perspective, how much equity should I want? Should I want as much as possible, as little as possible, or just enough? Again, the same thing. I don't want as much as possible. Let's say I meet an entrepreneur that's willing to give me 99% for my 200,000.
Because it's so much risk.
Why do I want that? I mean, something is obviously wrong. Like why he's crazy, or the business is worth nothing, and that's so.
That's how it's going to be perceived by the next investor.
There's going to be a problem because the next investor is also going to wonder why did they do a stupid deal like this? So yeah, so I think
Like, do I want to invest in a CEO that accepted these terms?
they'll have all the same questions about it. So I think the better approach is we start with what's a reasonable amount of equity for every deal. So I say I view like typical amounts of equity to go out in a venture funding deal is somewhere, here I say 15 to 30%. I think that's to be expected. Most venture investments will fall somewhere in this range, between 15 to 30%, with entrepreneur targeting the low end, investor targeting the high end, and final agreement being somewhere in the middle. Now, there are cases where it might go as low as 10, it might go as high as 40, it might, I would say, let's say 2/3 of deals in between 15 and 30, 95% of deals in between 10 and 40, and the remaining deals, somewhere between 5 and 40. Now, for credible venture capital deals, there should never, I don't think credible venture capital investors should ever be taking more than 35% of a company, unless the company is already in huge trouble unless it's the company is failing and this investor is just trying to is taking a huge risk to see if they can get something. On the other hand, you very rarely see deals like in the single digits unless it's a really small amount or the company is already hugely successful and everybody wants it. So I think when I think about what should be typical equity amount going to an investor in a typical venture funded round, I usually think 20% as a mental like an anchoring point. So that's what I would go into venture investment deals. I think we're going to be somewhere in the 15 to 30 range. If you're in a strong position, closer to the bottom. If the investors in a stronger position, somewhere closer to the top.
Series A, 20.
Oh, every round about the same. So I wouldn't. So although the amount of funding will go up every round, but I don't believe that the amount of equity going out should change that much because the valuation will go up too.
Has anyone been able to like aggregate the data of these kind of investment to normal market rate or typical investment changes over the years, things like that?
I mean, I have seen some research on this point, which is consistent with the numbers that I'm talking about. But most of the research that I've seen comes from the U.S. Because this is where we have a real long history of deals like this with a lot of data points. But the numbers I use are based on the U.S. data plus what I've observed in Southeast Asian markets. But interestingly, although people think it's very different, but at the seed stage, I don't see that much difference between the U.S. and Southeast Asia. Like, I think seed stage investments, seed stage valuations in Southeast Asia, I've seen mostly 1 to 3 million valuation. In Silicon Valley, where there's real data on this, it's 1 to 5. And average seed stage investment in the U.S. is $500,000. Average seed stage investment in Southeast Asia, I see somewhere to $500,000. So I don't think that there's a huge difference at seed stage between the U.S. and Southeast Asia, and I think there's pretty good data. Now, sometimes entrepreneurs think, wait a minute, but I saw in TechCrunch that this company in Silicon Valley raised their seed stage $10 million at $40 million valuation. Correct? That's what you're thinking about, right? Like I saw in TechCrunch. But the point I always want to make is, you know why you saw it in TechCrunch? Because it's news. You know why it's news? Because it's a freakish outlier. So, all the valuations and investment sizes that you read about in the tech press, they're the freakish outliers. All the real average investments that get done, nobody writes about in tech press. So these are the 1% or less than 1% investments that get done in freakish levels. Yeah, it's like, I always use the example.
There's a lot of strings attached as well.
Oh, yeah, we'll
yeah, we're taking only 20% of that amount, blah, blah, blah. Actually, there's some lines that you're not going to get this and this and this and this and this, then you're going to get another 20%. So that's also
but I always like to use this example. Let's say, man bites dog. Man bites dog.
That's news.
There's a headline. Dog bites man. It's not in the news. Why? Because dogs bite people every day. Yeah. It doesn't get in the news until the person bites a dog. And that's why you see these freakish funding rounds in tech press. So don't let those confuse you. Yeah. But if you go look at what's the real average investment, it's no different. Very little difference from what we see. But you started that. You had a question.
Oh yeah. With these evaluations, when they did the news, sometimes they get like 1 million, up to like 2 or 3 million.
You mean the valuation that gets reported in the news is different from actual?
Yeah.
Hard to say. I mean, I think usually, at least the deals that I know about that get in the news, the valuations are not changed. But I guess that can happen sometimes. sometimes too. Like I was just reading some Donald Trump, Trump Tower. Like, Trump Tower has like something like 58 floors, but it's marketed as 68 floors. So I guess if you're investing in some Donald Trump startup, it might be. Sorry, don't need to question. Okay, so let's talk about use of funds. So what should we use the money for? We talked about this already. We need to use the money to fund growth. Now, this usually investors and entrepreneurs can agree on this, but there may be some gray areas where we're not sure that we agree. So one area, potential gray area, is founder salaries. Like, do founder salaries drive growth? Do founder salaries drive growth of the company or no? No. Well, founders do. What do you think?
Is that a serious question?
Yeah.
So if we are in a space, so the portfolio is more on low space. So the many it's a very big portfolio that we can focus on business. We want to put they always pay more than the market. We want to focus on business and we will be more time and we talk more like this.
So drive or don't drive? So founder salary should be like 0?
Not zero. Well, I don't know. At this stage, for example, I said zero, but I would like to get to the next stage, but I can at least sustain myself. I don't need money off my pocket. And maybe when I get to B, get to market level, right? When I get back to the market. So, but it has to be appropriate to the stage.
Yeah, so I agree, like founder salaries drive growth up to a point. Because if founders, let's say founders have no money and they starve to death and die, this slows the growth of the company. So, or if they freeze to death because they don't have but we don't have to worry about that because we live in tropical.
That's why I moved to Vietnam. So I don't have to buy warm clothes. I can use this money to.
So we just have to worry that they start
fund the company.
But yeah, so it's a
Not founders shows that
What?
founders French. We went to Vietnam, started, and go back to France to start there.
And therefore, they don't need to buy warm clothes.
Thank you. They mostly having it's family, knowledge for like 1 to 2 years, they forget.
Generalize Meta has certain products. Yeah, but there's very cheap
It's not. It's very easy. It's very difficult to start a company in France. At least they can come here. If it works, they stay. If it doesn't, people don't. That's the reality.
so
Go back and look for jobs in France.
So okay, so let's say what's a reasonable for 10%?
At what stage?
Seed stage.
systems. Then start.
Yeah, let's say any stage. Actually, what's a reasonable salary at any stage?
They have to be efficient.
Yeah, I would say reasonable salary is to fulfill basic needs. We don't expect at any stage founders are going to be getting rich from their salary. And actually, in terms of I don't think we also don't feel like we need to pay market rate depending on how you're defining market. But because founders typically have huge equity stakes. And we want to see that if they're going to get rich, they're going to get rich from selling equity, not from salary.
From my experience, when we start a company, there's a few founders and part-time founders because they are going to compete especially at the early stage, for example, financial advisor. So for full-time, being helpful with the certain charity system. This is for not come with
Good. We don't recognize part. I think I've talked about this before. But we don't recognize part-time founders. There's only full-time founders, and
yeah, they are investor, but the strategies part-time investor. They not investor.
So we don't do this.
we can have them compensated if you're like I think you're talking about. We give them some options or some equity, right?
Yeah.
But we don't consider that those type of people get founders share. So, for example, founders we expect are going to have double-digit equity mix, like 10%, 20%, 30%, 40%. People like that are so-called part-time advisors, we expect single-digit, like 0.5%, 0.75%.
Some 3-4 they are not in time with they have money. They put in much money.
That's
They have a
different.
very good relationship.
If they put money, now they're investors, it's okay. No, because if we're selling equity, then they can buy equity back. So let's say they invested and they get equity in exchange for that, that's good. But I don't think it's a good idea to give significant equity stakes in exchange for work unless people are founders. Because why? Because one thing is people that seem really valuable at the beginning, they may become much less valuable. And actually, let's say they have somebody we'll talk about this later when we talk about the cap table, but if you have people on the cap table that are not active, that have large equity stakes, it causes you problems too.
Some people, they are not, they have some ecosystem. They don't spend time for them so much, but when you ask for any help, I'm very good. Businesses and sometimes you need to invite some people who enjoy that.
Yeah, but this is where, as investor, we'll be very careful with this stuff.
I understand, but someone is very nice and
Of course.
yes.
But what I'm saying is that these companies probably don't have companies.
It's okay, it's okay to use people like that and to work with people like that, but the amount of equity that they get should be very small. It's okay, and like I was saying, like 1%, 0.5%, 1%. And I wouldn't give 10, 20% to anybody, because later you're going to need that equity. And you're never going to get it back from them, or if you need to get it back from them, it's going to be very expensive. And the other thing that I really like to do, okay, if anybody gets equity, not for cash. So anybody who gets equity not for cash, we have to have a very clear contract, what are they contributing? Because, you need people like this, I can help you with this, I can help you with that, I can do this, I can do that, I can do this, I can do that. And then you give them equity and they do nothing.
No, I mean, this is that people planning that.
Not bad, not bad. They're just busy, or they have a lot of other things to do, or whatever. They're not necessarily bad. It's just like, and actually, a lot of this I think comes from mismatched expectation. So you give them 20% equity, and you think they're going to help you every week, and they think they're going to help you once a year. They're not a bad person. They just have a very different idea of what we're supposed to do. So I think if I was going to give somebody equity, not for cash, we have to have a clear agreement that says we're going to have a 2-hour meeting every week. You're going to make 100 introductions to potential clients. You're going to, and here's exactly what you're going to do. And then, okay, because we can now calculate how much is that. But I'm very nervous, and I have seen, not just nervous, but I have seen a lot of bad results of these sort of informal agreements with unclear deliverables where non-management team members get significant amounts of equity. And not because people are bad. I mean, if people are bad, then it's definitely not going to work out. But situations where it's two good people, but just different expectations.
But I think, here in Asia,
This is my experience all in Asia.
no. But here in Asia, Asian, like Chinese and stuff, and this guy has his machine, has his connections, and basically give him, and I do this. I don't look at it in a nice way, right? But for other local investors, such and such is invested in this company. I think that the thing is that actually it impacts the way people think about it. But I definitely don't think it's a good thing. Because I think it's going to actually work more, because these people, they can spread their money over 100 companies, okay? And essentially they're not bringing anything to these companies, right? So if that's smart money, if I'm from the outsider look at it, I would say this is not smart money.
I have seen a lot of founders disappointed in deals like this. And so they get somebody they think is a big name, and do everything for them and nothing, and later they're trying to figure out how to get equity back. So I would say I wouldn't reject all those deals, but I would be very careful. Okay, and then exit strategy and ROI. And how are we going to provide an exit for our investors through a trade sale or IPO? Trade sale means we're going to sell our company to a bigger company who will buy either almost all or all of the company. Other option is we will do a listing on a public exchange in an IPO. Every year, trade sales outpace IPOs 5 to 10 to 1, between 5 and 10 to 1. So every year,
it's probably going to be like 5%.
I mean, based on my statistic, that depending on the year, the number of venture-funded companies that exit in trade sales or IPO is somewhere between 5 and 10.
So
venture-funded companies, which is all we're tracking because we're looking at venture investment. I mean, so what does it mean? It means if you exit, you're going to exit in a trade sale. But IPO is yes. So yeah, it's a dream. So I would focus always on trade sale exit.
Actually, I would say my dream is trade sale.
Yeah, me too. I mean,
it's like
but I need a lot of entrepreneurs that want to do an IPO
because it sounds sexy.
They want to be they want to ring the bell on this. Or yeah, you know what I mean? They want to be famous. Like, okay, public company CEO, it's okay, but the reality is it's not going to happen. Like, how many Southeast Asia venture-funded startups that went to IPO on NASDAQ can you?
Just the question.
What's that?
I don't want to run.
So it's very rare. The only one I know in like the last 10 years is MOL from Malaysia. And this was yeah. So I think I would try to focus on trade sale as an exit strategy. Meaning we're going to sell to another company. Our company will become part of that company. We will cease to be an independent company, but we will most likely work for that company for some period of time. So we won't receive all of the exit proceeds up front. The significant portion of our share of the exit proceeds will be earned over time, usually 2 or 3 years, contract with the acquiring company. But if the company and the management team continue to perform after the acquisition, we'll get the full amount, and you might even be able to get more depending on how you negotiate. So I would target trade sale as the preferred exit route within this Facebook. I mean, Facebook, it's like, yeah, they turned down the acquisition, I think by Yahoo, $1 billion, and later they went on to do a $100 billion plus IPO. But again, it's like a freakish outlier. Facebook is the one in.
Yeah, you can argue also. We used to go to the graveyards to be acquired by Lucent. Like every company that's been acquired by Lucent, actually, this company disappeared after a year or whatever, and the whole thing is lost. So you can look at some companies that they acquire and say, okay, how much is worth for you? They're willing to pay you, let's say, 20% more. But you look at their history, how they dealt with the company that they acquired. And you can have another one. Then you look at the history, how they dealt with the company that they acquired. You have to take a look at that part as well. So,
All right, so exit strategy. Let's take our break now. It's 4:45, so we'll take a 20-minute break, and we'll resume at 5:05 to continue on fundraising strategy. And since I'm always on Zoom, nobody needs to see us besides me.
so recording is not being done on Zoom, or
Recording. So still recording.
it's nothing to do with Zoom, right?
It is.
It is. Which one is about that?
to help some
The first one?
and then he is responsible for samples of samples.
Oh, it's
Let me send you.
We just come in and give them knowledge to your shareholders.
No. It is something we talked about for 6 months to do. And
Just
just
really
really chance. So, that's what
Okay, so we left off here on use of funds and exit strategy. We talked about this already. So how do VCs make money? VCs make money through selling companies. More precisely, investors make money through being given an opportunity to sell their shares, which the vast majority of opportunities of which occur in trade sales or IPOs. But if we look at, I mentioned this already, but if we look at relative number of IPOs and trade sales, so this is looking at venture funding companies in the U.S. only, and the U.S. has the largest number of IPOs of any market in the world. So here we would expect that outside the U.S. it would be even greater. So you can see in the years that this study was done, we had 500 plus to 70, 500 to 50, 500 to 50, and this was only a partial, the 2014 number. And again, if we look at, so we can see there are many more trade sales every year than there are IPOs. And I think if we scale this up worldwide, so we would see that about 10 times this. So something like 4 to 5,000 trade sales every year against 500 maybe IPOs or less, a few hundred IPOs or less. Then when we look at the proceeds, so looking at how much what was average M&A deal size, again, we see somewhere between 100 and 200 million. And you notice this number is very similar to the number that we talk about in class. How much are we going to sell our company for? So I use average M&A deal size. Now again, M&A deal size can be somewhat misleading because it can be distorted by outlying deals, but still I think this is not unrealistic. Yeah, which is, okay, this is an interesting point to discuss. Which is easier to do? Sell your company for, is it easier to sell your company for 100 million or 10 million? What do you think? 100 million or 10 million? I mean, just which is, do you think there are more deals companies sold for 100 million or 10 million? I think, okay, I don't have the statistic on this, but my sense is it's easier to sell for 100 in the sense of what?
Actually, about VC invested company, or talking about?
In general. Like actually, there are not that many buyers running around looking for $10 million companies. So the problem is, who's buying those companies? Big companies are not buying companies that are $10 million.
I think that the 10 million actually probably going to go a lot for lifestyle.
But who's going to buy?
Lifestyle-wise?
So who's going to have 10 million to spend on that business?
Lifestyle-wise?
Like examples. What are some examples?
Okay. Go and buy a winery, for example, or go and buy.
How many of those transactions are there?
I think there's heaps more than these. Even big, like maybe 10 or 100 times more. That's what I was seeing. But these are the type of businesses that you would not even consider when you look at VC.
But I think it's deceptively difficult to sell companies like that because they're just not that much.
Sure. There's a whole marketplace for these type of deals, but nobody talks about it because they're not even in our game.
Yeah.
Let's say that.
So I think not that shortage of buyers, especially for startups. There's essentially zero buyers. For the only companies, startups that get sold at that level are failing startups that are used to be worth a lot more money, but somebody's buying for cheap.
I would say that if it's a good company and you're being sold for 10 million, then it's probably
so, or sometimes, yeah, so generally, or sometimes that can be, we call like acqui-hire. So there's another form of exit, which is not a real acquisition, not an IPO, but acqui-hire, where the company is essentially buying what you want to do. So they're not really as concerned with the technology or the product or the market. They just like the people, and they're willing to pay a certain amount of money to get those people to be part of their company.
There's many, let's say, different reasons that they can do beside that. It could be because real estate that the company has, for example. It could be because of physical assets that they have. It could be because of the number of customers. That means that they can actually reach these customers. So there's many reasons why you can do that.
Yeah, I'm talking about acqui-hire. So usually if it's a small acqui-hire, they want the people. If the company is being sold in a real trade sale, being acquired by a larger company, they're usually looking at the IP, the customers, the revenue, the brand, if they have a brand, market entry, if it's a market entry sale. And so a lot of factors that buyers look for, but it's for our type of company, the ability to sell in the 50 to 100 million range is a lot better than trying to sell 10 million. So, because there's also transaction costs in every one of these deals. And the transaction costs don't go down that much when the deal gets small. So as the deal gets smaller, the transaction cost as a percentage of total cost starts to become really good. Yeah, so let's I think if we stay focused on the sweet spot, we can both have relatively high percentage chance to conclude compared to other types of sales, and we can make a good return for everything.
Another point I think which is important to know, I think in general, IPO movement is susceptible to market conditions.
Agreed. And IPO,
you can see that here in 2009.
The IPO market got crushed in the financial crisis. And then also, you notice this, you know what this is?
Optimism?
Facebook. So Facebook really destroyed this average size. So this is looking at some data from Southeast Asia. I actually have an updated version of this slide, so we can use that as information. When I did this slide, looking at Southeast Asia exit, and this is again, this is not comprehensive because this is just my own data collection based on either deals that were reported or deals where I knew the value of the deal. And you can see when I did this chart in 2013, the value of exits had exploded from around 50 million up to 400 million. But 2014, it was like over 1.2 billion. And 2015 was about 800 million. So when I look at the updated slide, you can see a distinct significant upward trend in both value of exits and number of exits, which was just starting to become visible in 2013, but became pronounced in 2014 and 2015. 2016, I think, I don't have all the data collected yet, but I think the numbers are going to look pretty good. And 2017, I think we're going to see even bigger exits.
Okay, so I see Singapore and Vietnam both like orange. It could be just by mistake.
Actually, Vietnam's pink right here. Yeah.
I think Vietnam. Pink. Okay. Right, so which one did an exit this 2014?
What was the company?
Yeah.
I gotta go back and check what it is. But right now, so, okay, what wasn't happening in this data, and it's happening now, is right now there are at least 5 so-called unicorn companies in Southeast Asia, meaning 5 venture-funded startups that have achieved valuations of more than $1 billion through their venture funding mechanism.
Currently valued.
The
currency value of that stars in these stars. Back to the concept of unicorns.
Definitely $1 billion or something.
That means $1 billion US.
Oh, no, unicorn we're usually looking at $1 billion.
I mean, for Vietnamese, like for big now, it's hard to get to 1 billion.
Yeah, nobody's going to get that. No company, I believe, is going to get that in a single market in Southeast Asia. So all the current Southeast Asian unicorns are operating across multiple countries. Yeah, because I think it's a very good point. Like individual markets are too small to support billion-dollar companies right now. And however, one thing one pitfall I want us to avoid is to get over blinded by unicorns. So I think unicorns are okay, but they're not they're nothing to do here. I mean, I wouldn't set out to create $1 billion. Why? Although I encourage everybody to think really big, right? And that's a very important part of what we do. But I think better to set out to create a $100 million company because we have a realistic probability of doing that. The probability that we're going to create a unicorn, it's like the unicorn. That's why they call them unicorns, because they're
and if you look at them,
it's create only.
And okay, if we set out to create a $100 million company and we then grow to $1 billion, it's great. But if we start from day one targeting $1 billion, I think it's unrealistic. And it's gonna also, then we're gonna be disappointed if we. But so I would shoot for an extremely difficult, but still in context, reasonably achievable target of get to $1 million. And if you succeed at that and good enough, you can still get to that. And I think also this is one of the benefits we have in Southeast Asia, in our venture environment. Actually, in the US, you almost have to exit at $1 billion or more in order to support the size of the venture fund industry. So like the venture funds are so big that they need to invest so much money that they need to generate these very large returns to be profitable. But in Southeast Asia, it's not like that. So we can still become very profitable and everybody can make a ton of money with reasonable size exits. So these are examples of some exits. Okay, no, but let me botch was in, but undisclosed. So,
up to you.
So Property Guru was, do I have that in here?
Why are you guys taking photos of slides that you have already?
It's okay, take as many photos as you want.
You just
free.
That's just a
What's the you doing?
No, it's free. You can take all the photos you want. It's free.
Because you have this.
When I take a photo, I just make
So Property Guru was this 60 million was for a large stake, not the 100% acquisition. So there was a second acquisition of Property Guru.
It's corporate sampling platform for cosmetic brands.
So this is a few examples of some exits that are in my chart. The first two companies I knew very well because the CEVA is founded by two of the three founders were former students of mine from NUS. They went on to sell the company to Zendesk after raising very little money, as we talked about earlier. Yeah, here for around 30 million US, which is about, like we talked about before, about 38 million Sing. And then subsequently, though, because this acquisition was based in large part on Zendesk stock, I believe, has done quite well since this IPO. So total value to stock can be significantly higher than this.
Now they're raising this.
No, they're still running this, still running the Zapayam product within Zendesk. Because again, trade sale 2014, so I don't know the terms, but they probably have at least a 2 or 3 year earnout. So the way this works, okay, let's say you do sell your company for $100 million to a large acquirer. And now, okay, what percentage of the company are you going to have at that stage? How much equity do you have left at that exit? You make it to $100 million trade sale. You have how much equity left in the company at that point? Yeah, I would say a good estimate, 30, 40%. So let's say you have, let's make it easy, let's say you have 30%. So therefore you should get how much? 30 million. But in fact, you're not going to get 30 million, you're going to get how much now?
22.
If you're lucky, you'll get 10 million. Okay, maybe
How much now and how much later you need?
upfront.
Now, yeah.
How much upfront and how much earned out? So I would say maybe you get, if you're lucky, you get 30 to 50% upfront with the rest earned out. So let's say right now, if you have 30%, you should get 30 million. Let's say you got 10 million upfront, and then the remaining 20 million you would earn out over 2 or 3 years. And
You have to work for that company. That's 50 years.
yes, you have to continue to work with the company because now your company is part of a bigger company. And like we talked about before, when the company is purchased, one of the primary assets that the company is purchasing is the people. And therefore they expect you to continue to grow the business. Now what can, so there's a couple of different ways you can earn out. Sometimes you will earn out based on just time. So I have 20 million to earn out, and I earn out, let's say, imagine it's 4 years, just to make the math easy, so I get 5 million a year for the next 4 years. As long as I stay there, I get that. As long as I'm not fired, I can quit. That's one type of earn out, just based on time. Another type of earn out is based on performance. So, for example, when you sell the company and you justify the price, you're going to justify the price with a business plan. And the business plan is going to show your projected financial results over the next, let's say, 4 years. So the earnout may be based on the performance versus that plan. For example, let's say you forecast 4 years of what your profit is going to be, then let's say you get 50% of that, you might get 50% of the amount you're supposed to earn in that year. You might also get some combination of performance-based and time-based. So maybe you get half every year based on time, and the other half is variable depending on performance. If you have good negotiating leverage, if the acquirer is trying to include some performance-based parts of the earnout, you can try to get it both ways. So if we're 50%, you get 50%. If we're 150%, you get 150%. So, but that's generally how it's done. Now, the second company, Nonstop Games, this company did sell for $100 million US, which is exactly the number that we talk about all the time in class. So we know that this can happen. This company was based in Singapore. They actually incubated in our office, meaning they rented a desk space from us in Singapore. And we did not have a chance to invest in this company because they had already completed their Series A funding when they joined us in Singapore. But the founder of this company was from Finland, and which is one of the top game development. Their game development studio in Finland has a very active game development startup scene. But he came to Singapore because he felt the opportunities for game studio or game development studios in Southeast Asia was as good or better than it was in Finland. And in fact, his brother is one of the founders of the company that developed Clash of Clans. So he's already very hooked in. But he was quite successful because he sold his game development company to King in 2014. And everybody knows who King is. What's their most successful game? Recent game? Candy Crush. Candy Crush? Yeah. So everybody. No, it's somebody else is using my account, but I don't think it matters because I'm not talking to anybody else. So just the recording. So I thought this was an interesting case because why did King buy this company? Like, and how many people were playing Candy Crush like crazy back in 2013? Like how many people in our class were at one time like addicted to Candy Crush? How many people at one time were addicted but are embarrassed to admit it? Yeah, nothing to be ashamed. So, but a lot of people are addicted to Candy Crush, and at one point we heard like Candy Crush was generating $1 million a day in sales, but not anymore. So I think this is a typical scenario where this company was looking for what's the next big thing, so they want to buy an innovative game development studio that was developing real-time multiplayer HTML 5 games, which was at that time, 2014, at least pretty. Okay, so financial plan and financial model. Now I want to go introduce our financial section of the business plan. So financial section of the business plan is like a mini plan in itself. The financial section of the business plan is constructed in a similar way to the what I call product market fit portion of the business plan. If you remember that structure, we start with an innovative product that solves a painful problem for customers in a fast-growing market that we have identified an effective entry segment in with an effective strategy to capture and maintain our competitive advantage. So for the financial section, we want to make a similar argument, meaning we want to present a similar set of logical steps that walks the investor through why this business is a great investment, what makes sense as an investment. And another way to think about that, why investors that we're talking to should make this investment rather than other opportunities that they have. So we start out with business model. We start out the financial section plan with business model, which means what? Which I think we but in terms of the financial business model. We covered this already, so financial business model is comprised of two parts, which is what? Revenue model and cost drivers. So the financial business model shows investors, how does this company generate revenue? What drives the majority of costs? And therefore, how profitable can this business be in the long run? The next thing that we'll see in the financial section of the plan are financial projections. So financial projections are what? How do financial projections fit with the business model? So I would say the business model is like the skeleton of the financial plan. This is what the financial projections are hung on. So the financial projections that illustrate, given this business model, what is a reasonable set of financial outcome that can be generated by the business model. Now, I want to bring up one point when we talk about financial projections. So what is what's the purpose of financial projections in our business plan? And I'll also raise the point that some investors, some entrepreneurs and some investors believe it's a waste of time to do financial projection for seed stage companies because they believe that the projections are not going to be accurate. So they use like garbage in, garbage out. No point to do financial projections for startups because we don't have any historical data to base our projections on. I strongly disagree with this, and I think there's a
Wow, not surprised.
I think there's a fundamental flaw in that logic. So, what might be the fundamental flaw in that last bit. Or who thinks it's a waste of time to do financial projection for seed stage companies?
I think the financial projection for six-stage companies, they are very different than projections for later stage. I
Because,
think they need to be looked at differently.
because what? I mean, in what sense does it very different?
Well, first of all, what you just said before, there's so many variables that you don't really know about. It's still way too early in many cases.
Oh, okay.
And especially, by the way, if you're developing something that is disruptive, right, then you really should be in down. If you're just copying a model from another country, you can establish that it's actually very, very similar conditions. You might be able to actually do a pretty good projections. But in most cases, it could be completely wrong. So, probably what you want to do is to have enough financial projection to understand that this person really understands, right? There's a story which is consistent number-wise with his assumptions or market research or whatever.
So,
But you won't be able to look at the numbers and say, I would prefer these numbers to my numbers.
So, okay, so let's see if I can summarize that argument. There's less value in early stage financial projections because they're less likely to be correct than financial projections in later stage.
It's not only that they're less likely to be correct. I think there are just way too many assumptions.
But way too many assumptions by itself doesn't mean anything. Right? We're talking, what's the
Well,
difference?
it is, because assumptions will say into data.
But why do we care?
You're putting numbers based on assumptions. If your assumptions are,
But what's the
so many of them.
No, it's not really a
So what's the
Assumptions are made market
what's the
research.
ultimate? What's the
Right.
impact of the more assumption? The impact of having more assumptions is what?
Risk.
This of them.
Not being true or not being
Right. So that was the point. So his argument is, for whatever reason, like more assumption, less data, blah blah blah. The early stage financial projections for early stage are less likely to be correct than financial projections for late stage. That's why we shouldn't do it, right?
No, I didn't say that. They said they shouldn't do
Or
that.
that's why we treat them different.
I said they should be treated differently.
So my position is all financial projections are bullshit. It doesn't matter if it's early stage, middle stage, public stage, it doesn't matter. So therefore, early stage projections are no different from projections for public companies.
No, I would disagree with
But this is
this.
it's good. But unfortunately, for disagreement, it is empirically proven and also theoretically true.
Obviously, they're never going to be completely true. They're never going to be true. But the chances of them to be, how close to what you actually expect, we already know that DC don't really trust the numbers anymore, right?
It's not just that.
So,
let's say,
but the distance of, the question is, why are you going through this exercise?
Yeah.
And what are you expecting this exercise to do for you?
Well,
What I'm saying is that you're looking for different things.
I think we're looking for proving something different, but the outcome is in terms of, let's say, projected outcome versus actual. It doesn't matter what stage you go. I believe this is okay. Let's say we look at, for example, Wall Street equity analyst forecasts of earnings for publicly traded companies over any 5-year time horizon. There's no correlation between those forecasts and actual result greater than any simple model that just predicts that earnings are going to grow at the same rate at the same time.
So how about this, right? When you're going into early startup company, you're going to do a lot of time, the numbers and projections are going to be mostly top down. While if it's a much later stage, you have much more bottom up.
Which also doesn't because there's no information in future. There's no information about future future numbers based on historical numbers. Meaning historical numbers have no predicted value. Future numbers in financial forecasts.
What can you say?
This is finance 3101. There's no way that our future performance is in any way predicted by that.
Every company does that all the time.
Yes, every company does it all the time, but it's so bullshit. everybody knows that it doesn't mean
What's the justification? But you know, a lot of time what happens is actually
it's just a big,
That's a
it's
source of
big,
fear.
it's a number of gain, it's a game, right?
it's a big make believe. So if we're gonna make believe, we can make believe with seed states as well as
No, but there's also wishful thinking.
Why does it this?
it exists because a lot of people make a lot of money making believe otherwise.
No, I would actually argue these another reason, another thing that actually happens in companies.
This
Right?
is the main reason. Who makes money on this? The analysts that do these forecasts, the companies that base their results on these forecasts, the whole industry of projecting and predicting what's going to happen. But any empirical study of the value of these predictions show it's absolutely zero.
That's
They make
completely
money
different
off
than
the
what
people who doesn't know.
that's completely different argument. Okay? But you know, another element that actually exists because you're talking about what is the value.
Predicted value.
Yeah.
Predicted value.
You know, one of the things that I've actually seen actually happening, okay? So the way like big corporations, that's the problem. They work, okay? So they put all these projections, okay? Then you tie up key performance indicators to that. And what's going to happen is they're going to make everything in order to make sure that they really answer the projection, regardless whether it's good for the company, not good for the company. So they can get their bonuses. Right? So now you have to ask actually what sort of value you're actually asking looking for these projections.
Right. What I'm
Right?
saying
And then
is-
the question is who you asking the company. But that's very different.
But my point is, financial projections do not predict what's going to happen in the future. So therefore, we don't have to worry if our projections are more or less correct than other projections because none of them correctly predict. So, but that brings us to the point why do them. See, I think actually people misunderstand why we do financial projections because they imagine we do them to try to accurately predict what's going to happen in the future, but we don't. For a startup, why do we do them? We do them, one, what you said before. We do them because we want to demonstrate that we actually know how to do a financial projection for our business. Otherwise, we're not able to inspire confidence in the investor that you actually understand how the business model works. But two, I think our financial projections can actually prove something very important. Although they don't predict the future, they predict what? They do prove something very important.
Confident.
More than
Confidence.
I would say more than that. They prove that our business model actually can work. I mean, what do I mean? They eliminate at least one case, which is no matter what assumptions we make, this business model will never work. So we can actually disprove that with financial projections. Let's say, what do I mean by that? Okay, imagine we have a business model that means we're going to lose money on every transaction. Therefore, this company will never be profitable. But we don't know that unless we do a financial projection. So we can eliminate that case with our financial projection. And more than that, let's say we're pitching to investors that we're going to drive this company to $100 million in value. If we can model one case where that's true, we have proven that that's not an empty set, right? We have proven that there is at least one set of assumptions under which this can happen, which again, we don't know until we model them. So I think that's the fundamental value of financial projection for startups is we prove that under at least one reasonable set of assumptions, we can generate the financial results that we're proposing to generate with this business model. There's also an important negotiation benefit there because once we have proven that, now we eliminate one line of attack that investors might take when negotiating with us is your business model can never work. There is no reasonable set of assumptions under which this might work. And if you haven't proven that's not the case, that's very difficult argument to dispense with. Also, once you have proven that it is the case, this shifts the focus of negotiation away from is this possible to do we agree with the assumptions? And actually, negotiating about assumptions is a lot better negotiating position than negotiating about possible or not. Because possible or not, it's all opinion. Assumptions, we can at least apply some logic. So that's my argument for financial projection for startups. And I think another argument is, let's say there's two schools of investors. One investor thinks financial projections for seed stage startups are useless. And another investor, or another group of investors, think they're important. So let's say you have financial projections and you meet an investor that thinks they're useless. Okay, then you just don't have to show them. But if you don't have financial projections and you need an investor who thinks they're required, now you lose. So I think they're worth having in the event that you need an investor who requires them. And for investors that don't want them, you don't lose anything by having them. The good news is we have a spreadsheet model that you can use to do the financial projections, which we will share with everybody so that you can, if you want, save a lot of time in developing the financial forecast. Sure. What's that? It's already on the, yeah, it's already in the Facebook page under files, but if you didn't get it, it would be good to have it down. Because in tomorrow's class, I'm going to go over the performance model. Okay, so now what is the next step in our financial section after financial projection is valuation. And this is where, again, our financial projection is helpful. Because why? How are we going to derive the valuation for our company? What does valuation mean? When we say valuation, valuation of your company means what? When? So usually we mean, when we say valuation, we usually mean the value of the company at the point of investment. So you're raising money now, and one of the first questions you're going to get, or one of the questions you're very likely to get from investors when you're raising money, at what valuation are you raising money? So we will use our financial projections to help calculate our valuation. Again, if we don't have financial projections, then it limits the number of ways we can value the company. So tomorrow we will talk about 3 different ways to value our company that use our financial model. The first one is called comparables valuation. Second one is called discounted cash flow valuation. Third one is called VC method evaluation. So at least discounted cash flow valuation requires a cash flow forecast, which is very difficult or impossible to obtain without financial projections based on forecasting cash flow. So next thing we're going to have in the financial plan is funding required equity offer, meaning how much money do we need to raise to execute these financial projections in the business model, and how much equity we're offering based on the funding required divided by the valuation. Next thing we'll have is use of proceeds, so how do you use money, and then last thing, exit strategy and ROI. So you can see the financial section of the plan makes a coherent argument about the financial value of this business. We have a business model that generates a certain set of revenue and costs. When we model that business model over, for example, a 5-year time horizon, we can achieve a valuation of X. We need Y dollars to execute on that business plan. When we compare the amount of money, when we divide the amount of money we need by the valuation we derive, this is how much equity you're going to get. Here's how we're going to spend that money, and here's how we will ultimately exit the business, and here is the ROI that you will receive when we exit the business based on this financial model. So we have now answered pretty much all the questions that investors are going to have when they're reviewing this. Okay, so any questions about that?
So tomorrow the whole day begins.
Tomorrow we're going to go over the financial model and valuation. So use of proceeds means how are you going to spend the money that you got? And how are you going to spend it? What are you going to spend it on? Luckily, where are you going to spend it?
How you spend the money that you
How are you going to earn?
how do you spend the money that you earn?
Okay, so this funding round, we're raising X amount of money.
What do
Are
we
we
do with the
gonna
money that
Is it that
we
question?
Sure.
So this is more use of funds. So let's say you're raising $500,000. How are you going to spend it? And usually, of course, the big picture answer is we're going to spend on driving growth, but exactly how? So usually, I'll go over this later, but we're gonna hire X number of people. We're going to pay them this much. We're going to spend this much on product development. We're going to spend that much on sales and marketing beyond salary. Exactly how we're going to spend it. Not going to buy a new car. So yeah, so we definitely have to have, we definitely need to have a detailed spending plan, because if we don't, then investors are going to be very not convinced that we know what we're going to do. And so we want to see real detailed description of how we can spend money. Okay, so come tomorrow prepared to do a lot of numbers, because we're going to be looking at the financial model. But this can be a little, it's a little overruling if you're not used to looking at a lot of numbers, but it'll be worth it. All right.
Yeah, I was just about to say, it's a hard thing to do in Friday.
But I know this bunch can do the 12 things. It's
I think it's definitely-
Now just calculate probably these.
yeah. All right. So oh, great. Thank you. See you.
So, let me see if my